Hello everyone. Welcome back to my channel Risk Modeling Hub, your go-to channel for mastering credit risk modeling with practical interview-ready content that actually reflects what happens inside the top-tier banks. This is video 4 in our comprehensive 100 video series on ECL, PD, LGD, EAD models and validation. And if you have been following along, you already know from video 1 what ECL components are, from video 2 why banks need these models under IFRS 9 and Basel, and from video 3 we did a deep dive into the probability of default. If you haven't watched it already, I request you please check out the channel to understand it from the beginning and then come back here. Today we are tackling the second pillar of the ECL equation, the loss given default or LGD. And here's what I want you to understand upfront. If you search LGD explained on YouTube right now, most videos will tell you it's simply 1 minus the recovery rate. While technically that's correct, but if that's all you want to know, and when you walk with this into a creditor's interview at a major bank or a big four firm or a consulting company, you are going to struggle. They are going to ask you about the workout LGD versus the market LGD, about downturn requirements under Basel, about cure rates and recovery timing, about the bimodal distribution challenge, and about the statistical models used to estimate the LGD. If you can't discuss beta regression, or if the two-stage modeling or the regulatory differences that lies between the IFRS 9 and the Basel LGD, you won't get that role. So today I am giving you the complete picture, the conceptual foundation, the regulatory framework, the advanced modeling approaches, and the practical challenges that separate someone who read about the LGD from someone who actually built these models in practice. So let's get started. Let's start with the loss given default, what it actually means in a real banking environment and not just the textbook definition. So LGD represents the percentage of exposure about that a bank expects to lose when a borrower defaults. So yes, mathematically it is equal to LGD, which is equal to 1 minus of recovery rate. That is RR. Where the most explanations got stopped. So basically, what we need to understand is that how much bank that recovers, and when the bank recovers it, what costs are actually incurred during the recovery, how recoveries are discounted back to the default rate, whether the collaterals, guarantors, or the legal action are involved or not. All these questions must be answered before going into much deeper the LGD calculation, because that's the crux of the LGD. But when a borrower defaults, the bank doesn't just instantly write off the loan. What happens next is a complete multi-year process, which is called the workout process. The bank might negotiate the repayment plans with the borrower, seize and liquidate collateral, property, vehicles, equipment, pursue legal action and court proceedings, sell the debt to the collection agencies, write off the loan after exhausting all the options. This process can take months for unsecured loan retail products or 5 to 7 years for complex corporate syndicate loans. So the industry standard approach is the workout LGD, which is calculated as LGD, which is equal to 1 minus of NPV of net recoveries upon EAD at default, where NPV of net recoveries is equal to the present value of all the cash flows received post default minus all the recovery cost, and EAD at default, which is exposure at default, and this we'll going to cover in our next video. So the critical components include the recovery cash flows first, that is the direct payments from the borrowers who start paying again, collateral proceeds from the asset sales, guarantor payments or insurance payouts. Next involves the recovery cost, which includes the legal fees and the court cost, property valuation and auction cost, internal workout team cost, maintenance cost, or collection agency fees. The most important part is the discounting. This is crucial because recoveries happen over time. We must discount them back to the default date using an appropriate rate. And under IFRS 9, this is typically the effective interest rate, which is the EIR. And under Basel, it is often the cost of capital or the contractual rate. And this is why LGD on the unsecured personal loans is typically 60 to 80%. That is no collateral, slow recovery, high cost relative to the balance. While the well collateralized mortgages might have LGDs of 10 to 30%. These can vary significantly across the loan products because recovery process is very different. So, the key takeaway is that LGD is portfolio specific. A good modeler should not assume one universal LGD, but should explain how collateral, recovery timing, legal cost, borrower segment, and the economic environment affects the loss severity. Now, from the regulatory framework perspective, this is critical for interviews, understanding the regulatory distinction between the different types of LGD. So, first is the IFRS 9 LGD, which is the accounting or the provisioning LGD. And under IFRS 9, LGD is used for expected credit loss provisioning. The key characteristics involves the point in time, PIT. Forward looking, it should be forward looking. It should have an unbiased estimate. That is, it should not be neither conservative and nor optimistic. It should be scenario weighted. That is, under IFRS 9, it should consider multiple economic scenarios that we have seen under PD as well. EIR discounting, that we just discussed, the effective interest rate. This uses the loan's effective interest rate for present value calculations. Now let's talk about the Basel LGD from a regulatory capital point of view. It is used for regulatory capital calculation. That's the main purpose of it. And the key characteristics, first most important distinction is the through the cycle consideration. Long run average over the complete economic cycles. It is downturn biased. That is, it must reflect the stressed economic conditions. It should be conservative. That is, it should include the margin of conservatism for model uncertainty. Also, the cost of capital discounting typically uses the bank's cost of capital. The downturn LGD requirements, let's discuss that. Basel specifically requires the downturn LGD, the LGD expected during the economic stress. Under the EBA guidelines, it provides a detailed methodology. First is that it should identify the downturn periods when LGD was historically worse for your portfolio. It should estimate the LGD under the stress, average LGD during those periods. One needs to apply the adjustments as well, because if insufficient historical data is there, use model based or judgmental uplifts. Last and the most important is the conservative calibration. That is to ensure that LGD is higher than long run average and reflects the stress recovery behavior. So I hope you do have understood these 4 points from fundamental conceptual understanding. Now let's move further to the Basel LGD floors and from the interview takeaway perspective. Basel LGD requires the residential mortgages barely of 5% minimum. From an unsecured retail perspective, 3% should be of minimum. From corporate unsecured, minimum floor for that unsecured corporate exposures under IRB treatment is 25%. And similarly for real estate secured, I do have checked and it found it to be 10%. Do check at your end as well and let me know in the comments if any number varies. From interview perspective, Basel LGD is a conservative downturn bias measure for capital. But IFRS 9 LGD is a point in time forward looking measure for provisioning and typical scenario weighted based on the forecast conditions. So one should prepare themselves from the interview perspective as well, and one should have a deep understanding of what exactly each term means, right? Now, here's why LGD modeling is genuine and genuinely difficult from a data science perspective. And if you plot the LGD outcomes, the historical ones from a retail portfolio, let's say, you won't see a normal bell shaped curve. Instead, you will see a bimodal distribution, a U shape one, massive spike at 0%, significant or a massive spike at 100%, and sparse middle ground. That is, you can see few observations of 20%, 40% at 60%, few sparse observations, but high spikes at 0% and 100%. That's why the LGD is often called a U-shaped curve and not a bell-shaped one. So why the standard regression fails here? If you run a standard, or I would say ordinary least square regression on a bimodal data, which assumes that the normally distributed residuals can predict impossible checks and poor fit to the actual data distribution. So that's why the standard regression fails over here, because the distribution, if you have seen, it is not a bell shaped one, it is a U shaped one, severe spikes at 0% and 100%. So in interviews, if someone asks you how would you model LGD and you just say linear regression, it's an immediate red flag. You need to specialize the statistical techniques designed for the bounded or the bimodal data. This distribution challenges derives the sophisticated modeling approaches that we'll use in practice, and we'll cover that next. So, practical modeling mindset for the LGD should be that it starts with a distribution. And before choosing a model, always ask, is LGD concentrated near 0% or 100% or both? Are there any cured accounts and write offs driven by the different risk factors? Should the model predict one average LGD or separate the different default outcomes into the stages? Does the method keep predictions inside the 0% to 100% range, or it is going outside? So you should first plot the LGD distribution and separate the economic outcomes. Choose a suitable model class and then validate with the business behavior. And the key takeaway is that LGD modeling is not just predicting a number, it is modeling recovery behavior after the default. Now let's get into the actual models used in the Big Four consulting and top tier banks. Advanced LGD model selection should be driven by the portfolio behavior and not by the algorithm popularity. So the first question is not that which models give the best accuracy, but it should be that which model reflects how recoveries actually behave in this portfolio. So, for example, if LGD is mostly continuous and bounded between 0 and 1, a fractional response model may work well. But if there are spikes at 0 and 100%, a 0-1 inflated or a two-stage model may be appropriate. If recovery timing is important, survival analysis can help. And if we need a flexible benchmark, an ML challenger model can be useful. The practical expert lens is this, that the model choice should reflect the data shape, recovery process, regulatory explainability, and the validation evidence, and not just the advanced technique. So, our first approach to discuss is the fractional response regression. We should use that it is most common for retail and SME portfolios. And the working for this particular approach is that it models the conditional mean of LGD using the logit function, and it naturally bounds the prediction between 0 and 1, and it is highly interpretable for regulators, right? You can see the expectation of the LGD given the xi. It is in the exponential form, that is our logit function. The advantage of this approach is that it guaranteed the valid predictions, regulator friendly as well. But disadvantage is that it may not capture the bimodal nature perfectly. So it do have some limitations also. Next comes the beta regression. When you need to model the full LGD distribution shape, you should use this regression. So in this, this regression uses the beta distribution, naturally defined on a 0-1 interval, open interval, and it can model various distribution shapes and is often extended to 0 and 1 inflated beta regression. The 0-1 inflated version first models the probability of exactly 0% LGD, probability of exactly 100% LGD, meaning the total loss. The first 0% LGD means the perfect cure, and also the beta distribution for values between the 0 and 1. So advantage of this particular method is that it is theoretically appropriate and is flexible and is a very flexible distribution. But from disadvantage perspective is that it is very complex and requires careful calibration. So one needs to look at both these approaches very carefully. Next is the two-stage cure model. We should use that the industry standard for portfolio with significant cure rates. Stage 1 involves the cure probability model, where the models the probability that a defaulted account will return to a performing stage without the loss. Stage 2 is all about the loss severity model. For accounts that don't cure, model the severity of loss using the regression techniques, often called the beta or regression or the transformed or ordinary least square regression. Final LGD estimate is a combination of the cure one and non-cure one both. Final LGD, that is expectation E of LGD is probability of cure into LGD of cure at that stage plus 1 minus probability of cure into LGD, 1 minus probability of no cure. 1 minus probability of cure into LGD of no cure. There we should have no cure, but since we are doing 1 minus of this, So it becomes the LGD of no cure, right? The advantage of this method is that it directly addresses the bimodal distribution, provides diagnostic insight, and is widely accepted by regulators. Now, timing and recovery components matter. This is when the LGD is not just about how much it is recovered, but also when and how it is recovered. Survival analysis is useful when recovery timing materially affects the LGD. So, for example, recoveries received later have a lower present value. Some workout cases may still be open, and in some accounts, the final recovery outcome is unknown. And this approach helps the model time to recovery or resolution more accurately. Next is the component based LGD modeling. This is use this when the institution wants granular economic insight. And why this is useful? Because it shows what is driving the LGD changes. It supports the business challenge and model validation, and it aligns closely with the true recovery economics. Next is the machine learning approaches. Current usage is that it is primarily used as challenger models or for research. Common techniques involve the gradient boosting like XGBoost or Light GBM, which is excellent for nonlinear relationships. One can also use the random forest, which is good for capturing the interactions. Neural networks also, which is less common due to interpretability constraints. Regulatory challenge also involved, like the interpretability, because one must explain the model outputs, and here SHAP metric can help. Overfitting also, that is, may fit historical recoveries too closely and fail on the future defaults. From governance perspective, validators need clear documentation monitoring and business rationale. So ML models used for benchmarking and research, but primarily regulatory models remain interpretable and using the regression based approaches. Now let's discuss about the key risk drivers in the LGD model. First is the collateral related variables like the LTV, the loan to value ratio at default, most important for secured portfolios. Collateral type, residential property versus the commercial or versus the vehicle or versus the equipment. Collateral liquidity, how quickly can it be sold in the difficult situations. Borrower characteristics and the exposure related drivers. First is the industry sector for corporates mainly, like it is asset heavy or asset light industry. Geography, like legal framework affects recovery timeline and cost. Seniority, like senior secured or subordinate claims, what exactly the category is. Economic drivers, property price indices, unemployment rates, or interest rates. One should consider the economic drivers as well. Collateral haircut framework for secured LGD. When one is computing the LGD for secured products, the haircut you must have seen. You must have not seen, if not, you must have heard definitely. So for secured portfolios, LGD often uses a haircut approach. So LGD is equal to, as we have seen, that it is present value of net recovery upon the EAD, right? But where this present value of net recovery is equal to collateral value into 1 minus of haircut into 1 minus of cost rate upon 1 plus r to the power of t, where t is the time to realize that value. And the haircut accounts for market value uncertainty, for sale discounts, and the selling cost, and most importantly, the time factor. And that's what the haircut captures, right? So, a low loan to value ratio does not automatically mean a low LGD. Final recovery heavily depends on collateral liquidity, the specific enforcement processes, associate legal or selling cost, and the time required to complete the sale. But there are some data quality challenges as well that can distort the LGD, like the open account bias. Accounts still in a workout can't be excluded. So the solution is that you should use completion techniques based on recovery curves. Indirect cost allocation. You should must allocate collection department overhead, IT infrastructure cost proportionately. You should use survival analysis to handle the incomplete recovery processes and don't leave that alone. Model validation focus areas, because we should know how LGD models are validated in practice. First is the discriminatory power one. where one should understand, does the model rank order risk correctly? You can use the metrics like Gini coefficient or Spearman correlation. Calibration. Is predicted LGD close to the realized LGD on average? Stability. Using the metrics called the Population Stability Index. And the downturn adequacy. Does the LGD estimate remain conservative enough? So all these questions should be answerable at the time of the validation. Now let me give you the most common LGD interview questions and how to answer them confidently. So what is LGD and how would you calculate it? I am pretty sure that this you can explain to the interviewer in detail, right? But do not describe LGD as an instant loss. Strong candidates explain LGD as a multi-period workout process, discounted back to the default date. And here you can explain the discounting process as well and how it exactly differs in the from the Basel and the IFRS 9. So we have discussed that. You can scroll back, you can pause the video, scroll back a little, and then you can think about that, like what we do have discussed. And you can also discuss this practical recovery timeline from default date till the not final loss, not just directly describing it as an instant loss. Now, what modeling approach should you use for LGD? So here you can say that choice depends on the portfolio characteristics and the data quality. For retail portfolios with high cure rates, I typically use the two-stage model. First, modeling the cure probability with logistic regression, and then loss severity for non-cured accounts using the beta regression or the fractional response models. And for secured portfolio, component-based approaches, separating the collateral and the unsecured recoveries work well. So I always benchmark against the simpler cohort averages. If this question sounds tough to you, don't worry. In the upcoming videos, we will be going into the practical insights as well. The idea of this video is all about to give you a flavor of what LGD is and what exactly the questions can be asked at the interviews, and you should have a at least high level understanding what are we going to talk about. Now, what's the difference between IFRS 9 LGD and the Basel LGD? Very premium question. So you can say that IFRS 9 LGD is point in time forward looking one and unbiased for provisioning purposes using the EIR discounting and the scenario weighting. Whereas Basel LGD is through the cycle or the downturn bias for capital purposes using the cost of capital discounting. Basel requires downturn LGD reflecting the stress conditions, while IFRS 9 requires the current and the forward looking conditions. Go through this one and you will get a better sense of the guidelines. Now, why standard linear regression often fails for LGD? Or the question can be asked like, how do you handle the bimodal distribution in LGD data? So, the standard linear regression fails due to the spikes at the 0% and the 100% LGD that we have seen. And here we can use the specialized techniques like fractional response regression for bounded predictions, beta regression for distributional modeling, or two-stage models that explicitly separate cure probability from loss severity. The choice depends upon the portfolio's cure rate and the data characteristics. Right, so I hope you do have a good sense of what exactly the typical LGD distribution is. The spikes at the 0% and the 100%, don't say that it is a straight line, always say that it's a U-shaped curve. And one should also, at least from high level perspective, one should be in a position to talk about the better modeling choices that we have discussed, right? Now, what is downturn LGD and how would you estimate it? Here, the downturn LGD reflects the LGD during the economic stress required under the Basel for capital calculation. Following the EBA guidelines, I identify the historical downturn periods specific to the portfolio, estimate the LGD during those periods, and then apply the model based judgments if data is insufficient. And the final downturn LGD must be at least as high as longer run average LGD. So downturn LGD is not simply higher LGD. It is a regulatory estimate designed to reflect the loss severity under the economic stress, supported by historical downturn evidence, portfolio specific analysis, and conservative calibration. I hope the questions and the answers have give you a bit of flavor of LGD. right? So today we have covered LGD far beyond the basic 1 minus recovery rate definition. And you now understand that LGD is complex, time discounted economic measure because it requires careful treatment of the recovery cash flows, cost, and the timing. Regulatory frameworks also differ significantly. IFRS 9 requires point in time, unbiased estimates, while Basel requires conservative downturn biased estimates. Practical implementation challenges are also there, including the data quality, collateral valuation, and the model validation requirements. We also discussed the bimodal distribution challenge. It requires specialized techniques like beta regression, fractional response models, or two-stage approaches. Advanced modeling techniques are also used in practice from component based approaches to machine learning applications. So, that's the key takeaways from the LGD, and one can go through this for their credit risk interview preparation. And from industry perspective, if you are preparing from interview, you should now be able to discuss LGD modeling at a level that demonstrates the real practical knowledge. Most candidates stop at the textbook definition, but I believe that now you have the depth to discuss the actual modeling approaches, regulatory requirements, and practical challenges. So, in the next video, we'll complete the ECL trilogy, that is with the EAD explained, and that is the exposure at default. Right? We'll cover the credit conversion factors, off balance sheet exposures, revolving facilities, and how EAD interacts with PD and LGD to complete the ECL framework. So, if this deep dive have added value to your credit risk knowledge, please like, subscribe, and share the Risk Modeling Hub channel with your colleagues. Every video in this series is built on the same principle: accurate, practical, interview ready content that reflects how credit risk is done in the top tier institutions. Drop any specific questions you have in the comments, whether on modeling techniques or any interview preparation. I'll address them directly or cover them in our future videos. So, thanks for watching and keep mastering these models, and I'll see you in the next one. Thank you.